I'm the Tax Geek, and here are more of your taxes oversimplified. This video is yet another video in the series called Taxes for Landlords, and this video looks at what happens when you finally sell a rental property. This video builds on the knowledge gained from these 4 videos, which you may want to watch before this one. There's a link to a playlist above or on the end screen. We'll start with a little pop quiz. The first question is multiple choice. What is the taxable gain on a rental property when it is sold? A. The difference between what you sold the property for and what you paid for it. B. The amount of cash you receive at closing. Or C. None of the above. If you selected C, you are right. Although the figures from A are used in calculating the gain, the figure from B has absolutely nothing to do with your taxable gain. Now we'll try true or false. True or false, you can sell a property for less than what you paid for it and still have a taxable gain. If you guess true, again, you're right, and we'll see why in a moment. And finally, one more multiple choice question. How is the gain on the sale of a rental property taxed? A. Capital gains rates. B. Ordinary income rates. C. Both. Or D. Neither. In this case, C is the closest answer, but some of the gain might be taxed at another rate altogether. So let's see how gains and losses on the sale of rental properties are calculated. To put it simply, the gain or loss on the sale of a rental property, or any business use asset for that matter, is the sales price less the adjusted basis of the property sold. The sales price is pretty straightforward. It's simply the sales price on the contract. The adjusted basis, however, is a little more complicated. We looked at basis in the video on depreciation and amortization. Basis for depreciation purposes was the purchase price of the property, plus any acquisition costs and the cost of any permanent improvements you made to the property, less the value of the land. To determine the basis of the property when we sell it, we have to adjust it further. First, we add back in the value of the land. Next, we add all the costs involved with selling the property. This can include closing costs, real estate commissions, and any money we had to put into the property to prepare it for sale. When that's done, we subtract all the depreciation we took, or could have taken, on the property for the entire time the property was in service. So let's take a look again at Christine from the Schedule E video. She decides to sell her single-family rental property and finds someone who'll pay $275,000 for it. So let's figure Christine's adjusted basis. Her basis for depreciation was $148,000, and to that we're going to add back $40,000 for the land. Her closing costs were $12,500, and she spent $6,500 on preparing the property for sale. That brings her basis up to $207,000, but now we have to subtract 8 years of depreciation, or $43,048, bringing her basis down to $163,952. Subtract this adjusted basis from the sale price, and you get a taxable gain of $111,048. Let's suppose for a moment that the housing market did very poorly, and Christine could only sell the house for $175,000, which is far less than what she put into the property. Because of the depreciation adjustment to the basis, she would still have a taxable gain of $11,048. She would have to sell the house for less than the adjusted basis of $163,952 to realize a loss on the sale. So now that we know what the taxable gain on the sale is, how is the tax calculated on that gain? To figure out the tax, we need to split the gain into 2 parts, the $43,048 we took in depreciation and the remaining $68,000 gain. The $43,048 is taxed at Christine's ordinary marginal income tax rate, or 25%, whichever is lower. If you want to impress someone at a cocktail party, this is called unrecaptured Section 1250 gain. The remaining $68,000 is taxed at capital gains rates, which, depending on Christine's other income, can be 0%, 15%, or 20%. Calculating capital gains tax is, well, complicated, and the subject of another video you can watch right now if you need to. To extremely oversimplify this, if Christine's marginal ordinary income tax rate were 24%, the $43,048 would be taxed at 24% and the remaining $68,000 at 15%. So how is all this reported on the tax return? The sale is reported on Part 3 of Form 4797, where we see familiar figures from earlier, including the sales price, cost basis, depreciation, and total gain. The gain also shows up on this Schedule D and line 7 of Christine's 1040. The tax itself is calculated on this 2-page worksheet. I'm not going to go over this worksheet in detail, but it essentially completes this calculation we did before. Christine has $64,072 in income from other sources, and the final figure on the worksheet reflects both the tax on that income in addition to the tax on the gain on the sale of the property we calculated earlier. The result from the worksheet shows up on line 16 of page 2 of Christine's 1040. If she had only sold the property for $175,000, her $11,048 gain would have been entirely from unrecaptured depreciation and taxed as ordinary income, or 25%, whatever is lower. And if she had sold the property for less than her basis, she would be able to subtract the loss from her other income. And that's it. That's selling a rental property as oversimplified as possible. If you're considering selling a rental property or any large business use asset, it pays to estimate the potential tax burden at the time you're selling the property to avoid surprises when you file your taxes. Much more information is contained in the resources in the video description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. You can direct any questions, comments, or suggestions to the comment space below. You can email me at taxesoversimplified@gmail.com and follow me on Twitter at TaxGeekUSA. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.